Let's bring in Seema Shah of Principal Global Investors. Nice to see you. Welcome to Closing Bell.
Thanks very much. Great to be with you.
What fuels this rally in the second half?
Right, I think there's a couple of factors. I mean, this is a very, very strong environment for risk assets. So we're looking at a continued economic expansion. We are expecting a slowdown in growth, but we're certainly, it doesn't look like there's any indicator of recession around the corner. And then when you combine that with rate cuts, historically, there haven't been many instances of this, but when you have had a period of a soft landing, so solid economic growth, and then you've had rate cuts on top of that, rarely do you get such a strong environment for risk assets. So we do think that second half of the year is going to be a particularly strong one.
How reliant are we on the Fed? I mean, the market's had this incredible ability to go from, pricing in 6 cuts. Now we're pricing in 3 cuts. And even some of the, speak we've gotten today is casting doubt on whether we'll even get to 3. How much of it matters?
It does matter a bit, right? So I think for the broader market can exist as long as there is strong growth. I mean, that is going to be key because the earnings has to be there. However, when you start to look at pockets of the market, so some of the cyclical areas, the bits that didn't do so well last year, they are very much dependent on the Fed cutting rates. I'm thinking about small cap value, some of the more cyclical areas. So for those areas of the market, which we are quite positive on, but that is very much dependent on the Fed really delivering those rate cuts. We have to remember as well that, look, there's a kind of different shades of how the market could perform in a very, very strong environment where you don't get rate cuts. That's fine. But if it's seeing there's an inflation resurgence, that would be a particularly negative state of affairs. Certainly, that's not, of course, what we're hoping for.
Expand a little bit further on what you said. So you're positive on small caps.
We are. So we know, I mean, of course, small caps, they haven't had the best performance so far. They have been outperformed by the large caps still. But typically, when you are seeing strong growth environment, and then you've had rate cuts on top of that, those small caps, which are also showing really attractive valuations relative to the large cap space, they can perform well. So we do think there'll be volatility in the near term. They almost need to have the rate cuts becoming very visible, and that the market is very certain. So no more of the debate of, will they, won't they? But once there is clear certainty, then we do think that should be the green light for small caps to start to outperform. But I want to say, look, this doesn't mean that large caps are not going to perform well. We still have a particularly positive perspective on those large caps. It's just that we think that the small caps can actually join into that rally.
What I find interesting, too, from the notes that I'm reading is your positioning remains overweight in equities and fixed income, funded by an underweight in cash, right? This idea of moving cash out of money markets as that trade maybe gets a little long in the tooth if we think that rates are going to come down and that now's the time to play both fixed income and equities.
Yeah, absolutely. And this is really important for investors out there to start thinking about. There's $6 trillion sitting in money market funds. Of course, not all of it is going to come out into risk assets. But investors have been sitting on that cash over the last few years because they haven't been sure about what the economic environment is going to bring to them. They haven't been sure about what the Fed is going to do next. Well, in 2024, you're probably going to see a lot of those questions being answered. As I said, economic expansion continuing, plus Fed rate cuts. So we do think that that's going to be the time where you start to see this push away from money market funds into risk assets. And it's really important that investors get ready for that. And as I said, that is down to risk assets such as equities, but also within the fixed income space, on the credit side, so investment grade and high yield credit.